Should be here. All right.
All right.
Matt and Dave here
All right.
for the week ending March 28th of 2025. Last week of Q1. So kind of hard to believe. You always have to step back and pinch yourself. But weeks and months go so fast in life. The older you get, I guess the faster it goes is so true. How was your week, Dave?
Good. It seems like there's a lot going on. A lot of. I feel like the news cycle is now. We don't even have a news cycle anymore. You just have to shut off your phone to get a break from everything. So, yeah, a lot of action, a lot to discuss today. I know you wanted to dive deep into the U.S. dollar. So I say we just dive right in. I want to have a discussion about housing a little bit later. So I say we just let it rip.
Yep. So what we have next week to look forward to, turn the page on a new quarter, but I guess what's kind of billed as a really important day in American history coming up with Liberation Day, new marketing tagline. I guess it's better than Tariff Day for better for sales. We'll see how the uptake goes. But that'll be the subject matter we're talking about next week. Hopping in, I want to talk, first chart I want to talk about, and this will be really the only macro asset I'll put on the screen this week. But you'll usually hear me talk about either duration or the dollar. This week I want to focus on the U.S. dollar. So this is a zoomed out chart of the uptrend channel that the DXY index that measures the dollar versus mainly the euro, and then a little bit of yen, a little bit of British pound, and then about 5% weighting, very small weighting on other foreign exchange currency. But it's basically the dollar strength against the euro, the yen, and the British pound. And kind of the takeaway we've seen since FOMC Day 2 weeks ago, it was March 19th, Wednesday, was the last meeting, was a little bid catching the dollar's really significant downtrend it had been in since late February, when we had the meeting with Trump and Zelensky in the White House, and J.D. Vance, another key participant in that. I guess, what would you call it, an undressing? A foreign relations nightmare?
Yeah, cluster.
Foreign
Yeah,
relations
cluster.
mishap.
Yeah.
Yeah, I've it'll be hard to find a public meeting with two heads of state involved in a major conflict on the world scene going kind of more rough and tumble than what we saw that week. But that really catalyzed the big down move in the dollar, as the response from capital markets and foreign exchange specifically across global banks was basically, hey, we're not going to be able to count on the U.S. here to continue, from a Western perspective, to continue funding the defense side of the Ukraine conflict. And that's when, this kind of headline that's been building, this narrative for 10 to 12 years, it started in the 2015 Trump campaign. He'd been saying, we need NATO nations, like we need the European countries to pick up more share of the defense spending allocations. Took 10, 12 years, to get there in that big White House meeting. But that was finally it, 10 years in the making, we got it. So everything we've been saying in the dollar since that point has been, the free fall, if you will, of markets giving up on just counting on, the U.S. Public expenditures to fund the bulk of NATO's defense budget, EU's come in and realize, hey, we're going to have to step this up. And you've seen over the last 2 to 3 weeks the headlines building, with Germany looking to let go or remove the debt brake that it has in place. Germany still living, 100 years ago was the Weimar hyperinflation. As a society, there's no one left who lived through it, but they still kind of held on to that. Even in the 1990s reunification process where East and West Germany were coming back together, they were just extremely fiscally conservative, because in the back of their minds, they always knew what happened once you lose control or let go of the rope on public debt. Like, what can happen, right? Coming out of World War I, that really was the backdrop that set the stage for the Weimar hyperinflation. So they've always culturally had, for the last 100 years, a huge reluctance to just ramp up or accelerate fiscal spending whenever kind of one of these kind of economic lulls, you'll call it, or pressing situations comes into effect. They've always been really hesitant to just pull out the credit card from their wallet and just put something on the credit balance, if you will.
So Matt,
but I guess that's kind of
debt break.
Yeah, that's kind of a signal.
Yeah, Matt,
that's kind of a signal how big of a deal they think this Ukraine situation is. When U.S. pulls back, they're willing to break that kind of cultural norm that's really embedded in the society.
Matt,
go ahead, Dave. Sorry to interrupt.
No, I'm cutting you off. But you mentioned the debt break, and I know you're going to talk about this. That my understanding is that Germany's their ceiling on debt is constitutionally capped, right? The debt break is a literal constitutional cap. I think it's 35 bips, or no, it's maybe I might be muddling that up, but it's pretty small. So talk about that for a second. Like, what have they done?
Yeah. So, well, right now it's in negotiations. I don't want to get super deep on that, but we'll get into the fiscal expansion that's likely coming, assuming that the center left can form a coalition to get this through, the German governance system, without having to work with what you'll hear in the media broadly considered the far right, the Alternative for Deutschland Party, AFD. AFD would, broadly be against ramping up the fiscal spending, specifically for things like Green New Deal type projects or climate tech or defense acceleration, as to take the situation and involvement in the Russia-Ukraine conflict escalated to the next level. So you're seeing right now it's kind of in process with a coalition being built out, and we'll get into that. But basically what it amounts to is another $1 trillion in euro created of German boons, German government debt. And we'll get into the implications of that later. But that catalyst, like you see in the chart, this is a 12-year chart of the dollar. But just at the very right end, we actually got up. I think my cursor should pull through. But going into this year and even into January, we were on like a really strong run. The dollar was actually squeezing from mid-September, when the Fed actually started cutting, all the way until pretty much the Trump inauguration. And then since then, the dollar's been rolling over. But then that week of the week after the Trump-Zelensky White House kind of fiasco, we'll call it, you just saw the dollar sell. And the catalyst was that news. The U.S. Defense spending is not going to continue to subsidize the NATO effort, if you will, the budget, to the degree that we've been used to for 30, 40 years. And the flip side of that means, NATO's not giving up. It means the EU is going to have to step up and foot a bigger share of the bill. And the first kind of linchpin in that, or the main linchpin, is German fiscal spending. They do have the room. Their debt to GDP situation is not like what you see in, say, the U.S., for example, when we're at, you clock at 120 to 130% debt to GDP. Now, if you talk to, say, a Janet Yellen or someone from that side of the political spectrum, they'll say no, it's actually more like 100% debt to GDP because the Social Security holds in trust a bunch of those Treasury IOUs, and we owe it to ourselves, right? But in reality, all of those IOUs are going to have to be paid back. So consider it's something like 120, 130%. Now in Germany, it's like 66%. So you've got more room to step on the gas, right? So the two big accelerations in U.S. debt to GDP really came after the 2008 crisis, where we hopped on put that tab on the credit card to run what was the Obama infrastructure plan, like that act. I forget what it is at this point, but like 2009, 2010, you had a lot of fiscal spending in the U.S. It all went on the credit card there. That was a big jump up, and then COVID was the really big one, where we came out with the PPP, CARES Act, follow on the next year with Inflation Reduction Act, and then there's one more I'm thinking of that Biden had, CHIPS Act. That just kind of ran the bill. It just put a lot on the credit card, and now we're at 120, 130% debt to GDP. Point is, Germany still has room. They were kind of saving that capacity for the rainy day. And what we're looking at here, it's the slowdown of a credit cycle. We'll talk about other ones on this chart, but the room here is actually going to come from, in my opinion, the step up in German fiscal spending. This is probably, in my opinion, where the reflation at the bottom of this credit cycle is most likely to come from. So when I say that, right, bottom of a credit cycle, a dollar credit cycle, there has to be some driver, if you will, some economic force that allows the dollar to weaken, to kind of assist the dollar, the giant stack, escalating, always growing stack of dollar debt outstanding. Basically, something has to ease to make the debt service more affordable as the borrowers in the system increasingly have trouble as growth and or inflation slow down. So in some cycles like 2008 and 2020, it has to come from kind of the U.S. domestic economy internally. Those tend to be the worst ones, where it's like it's a credit event. If the government doesn't step on the gas very quickly with fiscal spending, let's say, or the Fed comes in with a massive QE, or we cut rates to ZIRP, some like this, the system looks like it's on very weak legs. Those are the worst, I'd say, of the storms you can get at the bottom of a cycle. But it doesn't necessarily have to be that way to cause a reflation, right? And we were going through this same process, I'd say, during the 40-year bond bull market from, I call it 1980 to 2020. But a key lever we had to pull was just, we started short-term interest rates at like 18 back in 1982. And every time you cut, you actually allow the borrowers to refinance their debt at lower rates. And that creates additional capacity on your income statement. And it just makes your debts easier to pay. And then all of that kind of room for each borrower just goes back into doing something else in the economy. Some of it goes into buying other financial assets. And that's why, you get a bull market up into the right and basically everything for 40 years. but it also means you can go out and, hey, buy a second car if you're a family after you mortgage your house, or send your kid to college, or take a vacation, or all of these things. So we were going through the same process for 40 years, but we could do it like you're just cyclically cutting rates lower every time, and you get lower highs and lower lows on interest rates during that whole cycle. Well, we hit the end game there, or as far as we wanted to take that from the U.S. system's perspective, the banks, the Federal Reserve, like savers, et cetera. We didn't want to go to negative rates. Like it's a terrible policy idea. Maybe we'll get into that a little bit. Germany, EU, Japan, they all did that. But what we see now is like the easing has to come from somewhere else. And I think for what we're looking at right now, so when Germany decides, or it looks very, 90% probability, let's say, that this German debt brake is going to be lifted, they're going to get the political consensus to do it. That should be most people's base case at this point, as a safe assumption. When you allow more German debt to be created, like this is the what's perceived in the EU, in the euro denominated financial system, the safest collateral. The German bonds are like the most sought after, but there weren't a lot of them because they've been so hesitant to just create or issue more debt. When Germany issues more debt, we're talking $1 trillion. I'll go through the growth rates that this implies. Because they're going to issue more debt, they're going to have to do so at higher interest rates, right? And so when foreign exchange markets see that, they say, oh, higher interest rates is better for your currency, so you should expect euro appreciation versus, rest of world foreign exchange, all else equal, to be moving up. Like that should strengthen the euro. Now on the contra side of that, you've got the U.S. situation. We just said we're not going to foot, a heftier share than the world of defense spending for NATO than what we've been used to paying. And so this should actually lower the amount of defense spending, all else equal, over the next 5-10 years. And so that means fewer potentially treasuries. Like directionally, that means pressure is downwards on the amount of U.S. Treasury sovereign debt that the market is going to have to digest. Fewer bonds to digest means lower rates. Lower rates means a lower value for the dollar relative to rest of world basket. So euro defense up, U.S. defense down. That was really the driver here of what was one of the biggest weeks in terms of percentage change of dollar FX we've seen at least since 2008 on that candle that we just went through. So that has huge implications. And now when we're talking about, in the grand scheme of things, this channel, the upward channel that the dollar's been in since the 2008 GFC aftermath, what this really looks like to me on the chart is I put a band in the middle, the green, on kind of identifying where, if you're a monitor, if you will, of where the dollar trades in FX, say the Federal Reserve, people like that, like where the dollar trades is a huge input to stability in the global financial system across all currencies, assets, international trade, all of the above. Dollar is probably your most important input. That green shaded region of the broader channel, that's kind of where I view as this is when the machine is humming along, it's working well. Dollar's not too strong, dollar's not too weak. And basically we've been in that kind of Goldilocks zone since the dollar rolled over in June, July 2022, when basically the Fed hiked enough to squeeze the excess dollars that were created in the COVID fiscal and monetary impulse in 2020 and 2021. All of those got sopped up through facilities like the RRP, the setup of the SOFR market, a high Fed funds, all of the above. But basically, we've been operating within that green channel since July of 2022. Now, I will call out, it's getting more volatile, like just bouncing off of those ranges. Whereas if you look at the prior periods of kind of when everything is staying on the rails within those channels, there were some, like the window in 2018 and 2019. You can kind of see up there if my mouse is carrying through. It traded on a super tight range. So dollar euro was super stable, dollar yen, everything just wanted to be like just humming along. But it's only when like the volatility picks up, and you can see it in the trend runs that the dollar will go on. That tells you how much volatility is kind of underlying in the system, and what that's telling, what that's really giving you information on is the actual input, the dollar here. It wants to move, like there wants to, as volatility picks up, that's indicative that price wants to change state. It wants to find its new temporary equilibrium. So that's what I take away as the dollar's been getting more volatile in these channels. It doesn't mean it's happening tomorrow, but or next week, but somewhere in the future, there is a move coming for the dollar. Now, it could be, some people, many proponents, you can find them, say there's going to be a giant dollar squeeze, milkshakes, etc. But if you just look at what we've seen in the last 18 months, ever since the dollar rolled over in 2022, you're starting to see higher highs and lower lows. So the kind of cone that the dollar trades in is getting wider. That expanding kind of vertical width is telling you, hey, watch out for volatility. It's picking up. And then as volatility picks up, eventually one side of the market, whether it's the bulls or the bears, are going to be determined, right? And that's where you can get big secular type of moves that ultimately play out. Now, if you look into which side looks more favorable here, like in terms of who's got a better hold of the rope in this tug of war, I'd say listen to Scott Bessent and the U.S. Treasury and what they want to do as a key. It's very clear they want the 10-year to stay stable and low. A blowout in the 10, past 5 into 6, etc., that would really represent a kind of a political failure or rejection of everything that this new administration has been set out to do. But so Treasury actions want to move with the I'd say bulls on bonds, if you will, yields down, especially at this point in the credit cycle where we're at. But yields down would be synonymous with dollar lower, all else equal, right? So if you're playing like, all right, old school adage, don't fight the Fed, right? Well, you also got to look right now on the Treasury's fiscal situation. Don't fight the Treasury. They need to fund themselves. And to do so, getting that interest cost stable or reduced is a key tactic for improving the fiscal situation of the U.S. government. So, yeah, if you're going with that old adage, don't fight the Fed, it's like don't fight the Treasury, right? We want yields low. There's tools that can be utilized too in the toolkit. Like there's, in case of emergency, break glass. You've got things like revalue the gold at Fort Knox from $42.44 an ounce up to $3,000, $3,100, wherever it trades this week, right? Gold only goes up lately on days that end in Y. But you can revalue the gold, and then once you do that, you just top off the TGA without any credit creation, and then Treasury wouldn't necessarily have to go out and tap 30-year bonds if it didn't want to, and blow out the long end of the yield curve, or the 10-year, for example. It could fund itself with that revaluation of the gold certificates up to market price or wherever it wanted to take them to. And my point there is there is a mallet that Besant has to break glass in case of emergency. Get out the defibrillators or whatever those the emergency paddles are at your local gym or wherever that everywhere tends to have
AED
these
is
days.
the term you're looking for.
AEDs, yeah, thanks. And they can keep rates low here. They have the tools to do that. So all else equal, it looks like the setup here in the direction of where the big institutions who are in the driver's seat, they can take the dollar lower if they want. They can keep yields contained. So I would not bet against the Treasury in this realm. Now there are repercussions. Like if you do take the dollar lower, what happens? Well, price levels may increase for goods and services in the economy. So everything comes with a trade-off. But at the end of the day, the Treasury is not going to default on its debt, or it doesn't want to, and they hold the cards to keep that from happening. But continue to watch out. The last thing I'll talk about here, FOMC day was the reversal. So remember, the big takeaway from the March 19th FOMC press conference was the announcement that QT had been slowed down on Treasuries runoff from the Fed balance sheet from $25 billion a month to $5 billion a month. Basically I view that, why 5? Like, it's just a trickle at this point. Like 5 times 12, $60 billion a year. That's one 4-week T-bill, right? Like, and we do one of those every week. So essentially it rounds down to nothing. I think the headline was they didn't want to say the QT program was fully ending, which would be a bigger attention grabber. But I think the reduction from 25 to 5 on treasuries was a huge move. Basically, it's another signal here. Same way we said with, say, Germany and other EU member nations picking up a greater share of the defense tab for NATO. That means U.S. contributions or fiscal spending going into that budget line item is also, it should be all else equal in declining because of that. It's the same thing for QT. That's $20 billion a month extra in U.S. Treasury debt that the market doesn't need to absorb. So that's a reduced amount of supply that the market needs to absorb. All else equal, that means the clearing price at new auctions should move down for yield, should move down. Lower yields on the new on the runs means lower dollar, and that's exactly what we've seen for the story of this year. So I think we'll leave it there. I think we beat that horse to death. But to me, the dollar is the key thing to watch as we come into April and we get more information on what we're going to see on tariffs next week on Liberation Day. So this will be obviously the dollar, you want to watch it, but the response is something, the directional move is something we want to watch closely coming out of next Wednesday, April 12th. All right. So this is a terrible chart. I didn't realize this. I need to make these lines thicker. But what I want to talk about here is the Bund impulse here from that credit creation. I'm going to put this on a zoom in. even beyond that, right? Because if you think about it, when a bank, say, take a U.S. perspective, if you want to get a home mortgage or a commercial loan, the bank has to hold reserves again, like to at the Fed, at the regulator, to create that loan, to fund it. And so if you have more treasuries, banks can go out and create more credit. What you get is a credit impulse in your broader financial system. Now, EU or even Germany, like the credit impulse has been historically, somewhat constrained. Once you get into, here's the, slide 3. Once you create, like in the U.S., you create more treasury debt. Like take the example from 2020 when we just went on this, crazy fiscal impulse with PPP, CARES Act, et cetera. That translates into more credit creation in the broader economy, which also translate in a credit-driven monetary system, more GDP. So it really just accelerates growth. Now, if you take that analog and you copy over to a euro-denominated credit market, if you increase the amount, if you push an impulse through and what's viewed as the most desirable collateral from the system's perspective through the EU credit system, and this is cross-border, right? All of the other EU countries can buy these boons as well, and they will. It's not anywhere near to the point where, say an Italian bank is going to worry. They will not bat an eye on this $1 trillion of increased fiscal spending. Germany taking up, say, its debt to GDP from 66 to 80 or 90. Like, it will not be a credit scare. What you're going to get is, because the banks are sitting on a bigger quantity of what they view as, the best collateral in their system's point of view, they're going to go out and create more credit on top of that. More credit means more economic activity. It's, I guess, essentially just a giant stimulus into this flywheel. And so what you're really seeing is this bid that's hitting the EU market equity, Germany, for like every EU equity market has just gone on a tear, and you've seen this flip of the trend, the 2008 to, let's say, 2024 outperformance of U.S. equity markets versus European markets. You've seen a massive flip, in Q1 of 2025 as the market is starting to front run and price this in. Now, is it done yet? I'm a firm believer that these trends, these big secular trends, take a long time to fully price in. I don't like it. There will be stops and starts, right? This big run-up we saw in the German DAX, for example, in February, can't continue to grow at like 15% a month in perpetuity. Like, that just doesn't happen. But I think the broader trend is this fully priced in, right? Yeah, we may get some pullback here a few months, but like, this is going to be an ongoing secular theme as the EU is really, we talked about this last week with like the Savings and Investment Union, and this week we're talking about the Bund impulse, and then what I'll get into here on German banks' balance sheet expansion. But you're talking about a big secular trend for that would essentially like has a long tail and would give a huge tailwind to both euro secular strength versus other foreign exchange, and then also European equity markets relative to the rest of the world. So I think this is something that is more likely than not just getting started. Just assuming the German government coalition that's trying to get put into place doesn't trip over its feet, for example. But this is shaping up to be a big story, potentially a decades-long type of effect. And if it is that type of transition, that's where you're looking at charts, right? Trends we've been looking at, like dollar uptrend 2008 to what looks like still going on in the present, in the post-2008 environment. This is the backdrop where those longer term, call them 10 years, in the grand scheme of history, those are nothing, right? But that's when those 10-year trends can break. So I would say be ready, because this dollar uptrend, if that does break, something that we've counted on for now, since it's been 17 years since 2008. It's hard to believe, right? That'll be extremely disruptive to markets, and this is where, if you're, say, an American investor and all you're counting on is 60-40, and all that's in your 60 is U.S. equities, what if those start underperforming rest of the world? Oops. What if your bonds continue to struggle, right? They're going to be, directionally, pressured with yields lower from a nominal return standpoint, but then in a elevated inflation environment, that sleeve of your portfolio struggles to keep up its own purchasing power. Oops. This is when, from a U.S. investor's perspective, you better do your homework and make sure you're ready, just in case. Hopefully everything works out smoothly, everything goes well. But as always, prepare for tough situations in your portfolio, and make sure you can weather those. All right, now on to the topic of German banks' balance sheet expansion. I talked about, the boons being the safest collateral in the system, right, in the EU financial center. If you had your choice over a German bund or a French oat or whatever, the Italian sovereign, any other EU country, you would much rather have the German, and that's why their bonds trade at a premium for all euro-denominated debt. The white line on this chart is the aggregate balance sheet, total assets in the German banking system. And then the left is that same chart we saw in that prior slide we were reviewing on total German bund debt securities outstanding. And you can see, I could zoom in, show the correlation better, but basically what you see, kind of two different eras. From 2000 up until the European debt crisis in 2011, 2012, you saw German debt increasing, right? And then starting in the the EU debt crisis, the pig situation, if you will, which ECB has now said you're not supposed to call it pigs anymore. That's terrible marketing. I don't know what else we're supposed to call it. The 2011-2012 EU debt crisis, we'll call it that. German bunds started, the supply, they started pulling back. They started declining. Like forced austerity started kicking in, all this stuff. Decisions were made under Chancellor Merkel and kind of that era's government. And then 2019, 2020, you saw the German debt issuance kind of pick up again in response to both the economic slowdown, the global economic slowdown that was materializing, especially in half two of 2019, but then with COVID showing up on the scene, stepping on the gas maybe a little bit more. Now, the German sovereign debt, step up was nowhere near the degree that the U.S. government and the Fed stepped in as to bail out the rest of the world and the dollar system. But still, you can see when German bunds are expanding, basically supply, German banks are expanding their balance sheets. They're what that means is they're creating more credit. They're lending into the German economy, or equivalent, you could be saying they're creating money, right? A credit-based money. There's more monetary supply available. And if we go through this situation where the German political consensus decides not just to keep increasing bund supply, but to actually increase by an incremental $1 trillion over the next 10 years, what you're essentially going to do, what you'll essentially see here, by taking bund supply up, banks are going to ratchet up their supply of credit into the economy, plus all the savings that's going to come in from households and private businesses, et cetera, the private sector, with the savings and investment union plan, if that goes through, that's going to be a massive credit impulse in the EU economy. What does credit impulse translate into? Higher nominal GDP, economic growth. Now, the key here in terms of are you creating a bubble or just a financial asset bubble or real economic value? From an Austrian perspective, credit creation that's funding by savings is the actual key. So if the government is just creating more and more debt and not doing anything to increase savings to fund it, that ultimately leads to very similar situations to what we've seen in the U.S. Let's just call it that, like where you just get more financial asset appreciation, but your real economy, like private actors, just start doing or start allocating time and resources into non-economic things like NFTs or OnlyFans, like just not productive economic activity. Let's just say that. So the key thing here is getting German savings or EU savings to fund this credit expansion. And I think the answer actually is the approach with the Savings and Investment Union is, well, we already have the savings. We just need to unleash the Kraken is kind of the take. So basically what this is we're looking at a 2x potential increase in the growth rate of German banks' balance sheet expansion. Now, what that translates once that crosses borders in the EU, I think this is where you'd have to do a lot of modeling to figure that out. But I can tell you this, directionally, it should be a credit impulse in the economy. And kind of the first move when, as George Soros says, what's the first thing you do when you identify a bubble or a credit bubble? You bid, you own it, right? You want to be the first into a bubble. And that's, from my framework, what's really driving a lot of the behavior we're seeing in capital being pulled out of the U.S. The U.S. bubble's not cool anymore. Mag 7, sorry, we've had enough of you. The hot new shiny thing right now is deploying into the EU, German industrials, EU defense companies, EU financials, things like that is kind of where global capital is seeing, hey, this is the fast money is moving into to bid the bubble as it sees, a new one potentially forming. When I use the term bubble, I, do it, politely. Maybe this will be economic, because as ECB makes the claim, German citizens are sitting on a lot of private savings that are just sitting in bank deposits. European corporations, same thing. That needs to be unleashed is their argument, and hey, maybe that's true. We're probably going to find out, but this has all the longevity to be, in my opinion, one of, if not the main driving financial narratives for the next decade as this is plotting out. So used up a lot of hot air there. Dave, any comments on this? And then we can get into the U.S. housing, which is kind of a direct response, right? We're seeing capital flows out of U.S., foreign investors selling their Mag 7, selling their SPY shares. That's pulling out, weakening the dollar. And I think that's translating into markets in the U.S., such as the U.S. housing market. So the next topic, that's the next subject we want to dive into here. But any parting thoughts on EU fiscal and maybe how that translates into what we're seeing in the U.S. and key market housing, right?
I mean, you spent a lot more time on this. I think to me, it's all about, you talk about this a lot. It's about the implementation, and there's still, to me, a lot of, it seems like there's a lot of, not to call it barriers, but there's still political approvals that need to happen. If you talk about the union from the European Commission, that's proposed. It still has to get approved, and then they can actually go and enforce it. So
I've learned something. Always take a European technocrat at their word. Mario Draghi said over 10 years ago, whatever it takes.
Yeah.
Trust that they will do whatever it takes to like get the bureaucratic vision across the finish line by hook or by crook.
Yeah.
So
Yeah.
I don't doubt them. You say don't bet against the Treasury right now. They directionally go with the big players. Same thing for European capital markets. I say don't bet against the bureaucrats in Brussels from the market pricing standpoint, because they have the capacity and the ability to instill their vision.
So that's a good, yeah. Let's bring it back across the pond here. I'm curious to get your thought. I'm gonna go through some of my thoughts on housing, and Matt, I'm curious to get your take on how this nets out with rates, the dollar. So one thing to note: this morning, PCE index came in hot. Right now, S&P 500 is getting absolutely clobbered. It's down about 2%. So that's your backdrop right now. So the real question here we want to talk about is the U.S. housing market telling us something? Is it in a but there is a running narrative that we're in a scenario of kind of a white collar recession. Matt and I live in Seattle. We know a lot of people in the tech community, and in that world that those companies have pulled back. They're not hiring as aggressively for sort of this. You almost call it sort of like high end, mid-level professional, sort of middle management layer. And we know software development is also taking a hit. And those are
they're getting squeezed by AI.
Squeezed by AI, that's right. And possibly just over hiring as of a few years ago. So those are highly compensated jobs. This is a high cost locale. So the early cracks that I'm seeing, at least, is at the top end of the market. When you're looking at these high cost locales, those high-end homes are now the ones sitting on the market the longest. Those ones are, big houses, $2-3 million, depending on where you are. Those ones are sitting for longer and longer.
Well,
what you're not seeing is, go ahead.
That's the secondary market, like your home hitting the market a second chance. Like those are taking longer to sell, et cetera. But these home builders are the primary.
These are the primaries. Yeah.
Primary market.
Yeah.
First time. the house IPO.
Yeah, well, keep in mind that, yeah, but Toll Brothers and Lennar, they are building, we'll get into this in the next slide. So okay, so what do those guys do? They're building typically mid to high end homes, right? They're single family homes, and they have different price points, but those are sort of like what I would call like the American dream style homes, like garage.
Just a whole new neighborhood comes in.
Yeah, exactly. Well,
20, 30, 40, 50 homes just on a
exactly.
big plot of land.
So,
And they're single family residences,
right.
3, 4 bedroom type
Yep.
of home, like the American dream type of
Exactly.
home, as you mentioned. Yeah.
So who's okay? So everyone's getting squeezed in this market, and the market. The term I've used right now is that it's kind of going flat. It's a little frozen. You're not seeing massive declines in prices, but you're also not seeing a lot of uptick anyway. It's just kind of going sideways. But if you look at the two companies at the top, one. Um, so we'll jump ahead here. So what does Cavco and Champion do? What kind of houses do they build, and why are they up? So Cavco and Champion they're modular homes. So they're building smaller. They're building smaller housing. They're building dense communities. They're building in. We can go up to this other slide here.
Which one is it? Oh, this one?
Oh,
Cavco?
yeah, I've got it. I think I have control over this, the presentation right now.
Okay.
Yeah. Okay, so what are these guys doing, and why are they succeeding? Well, they're building smaller houses is what they're doing, and they're building not all of it, but much of it in factories and then shipping it to a site. So what's the benefit of this? They can build these homes really quickly. We know that we're 3 to 5 million housing units short in the United States, so we can build these things faster. We can build them for 50 to 70% cheaper than on-site construction. They're more efficient, so fewer labor hours per unit to produce. And it's easier to set these things up in low cost of living or lower cost of living locales that don't have as much infrastructure. You can clear a site, you can get these things in, you can design that neighborhood without as much infrastructure. So the other interesting thing to note is that the association, sort of mental association of what a modular home is, I think is going through a bit of like a rebrand, in that these houses don't look like the classic sort of double wide trailer that we associate with like trailer parks and things like that. They are, you can go to these companies and look at these things. I mean, they're actually pretty nice houses. They're small, but they're modernized. They have nice fit and finish, and that's just due to upgrades in materials and just the business in general. So Clayton Homes, which is owned by Berkshire, is you bought that with a specific home and community in mind, right? So it's difficult to just change your site plans overnight, usually due to zoning or what was approved in the first place. But the behavior that these companies are going through is twofold. One is they're going to construct smaller homes, denser units, and what they're doing currently to keep themselves sort of profit is, and you'll see this, you can go see this in a lot of different data sets. They're offering a ton of incentives. So if you look at their financials, the big builders, they are they're basically delivering the same revenues, they're delivering similar throughput, and you'll go look at the price points to say, oh, they sold that house for $500 or $450,000 or whatever it was. Well, what you don't see is that they did a $50,000 mortgage buy down, and their throughput and deliver, they're going to have to offer these incentives.
So I've got the slide up, square feet versus price per square foot.
Yep.
So median square foot declining, price per square foot still continues up and to the right. I think this couples up nicely with the trend of international capital pulling back from the U.S. market, the U.S. dollar. A lower rate environment may be part of that. Get the lower rates the government needs to service its massive debt overhang that has built up over the last 20 to 25 years of let's just say ill-forsaken policy decisions. There's been a lot of them, but due to that, you're seeing price continues that upward trend, but what you're getting at the consumer level, the bang for the buck is squeezed. And I think it's kind of the boom times versus lean times, right? This is, for better or worse, this generation of Americans is going to have to go through the belt tightening. They're going to have to learn to economize, do more with less. And I think this juxtaposes very nicely on the compare and contrast, which you look back in our own lifetimes, right? And you just saw kind of the ridiculousness of housing, right? The McMansion, right? Which you're going to see a lot of rotting McMansions across the U.S. because like the design of these things is poor construction, the layouts, like the architecture. I'm not an expert on architecture, but I have a lot of friends who just say like these houses, these McMansions, like the way they structure these just ridiculous open foyers in the entryways, for example, just stuff like that. Like they cannot the structure, the scaffolding can't support itself. Anyway, my point of this is like these are not going to age well. It's going to turn out in hindsight, my opinion, very likely to be a lot of capital misallocation over the last 40, 50 years. It's going to get marked to market, both in financial terms, but also in just the depreciation of the asset. Like eventually, one of these stories, I'm just pulling anecdotes out, but remember the rapper Nelly? So I grew up in Missouri, right? And there was a St. Louis suburb, Lake St. Louis, and when Nelly made it, he bought this like just massive McMansion, like the finest thing on Lake St. Louis that money could offer. As someone who's achieved the amount of success in music and arts that Nelly has, fully should and well deserve, right? But the house, I think it was the mid 2010s, like essentially he just abandoned it. Like he couldn't sell it, and you got this giant McMansion that's essentially just rotting out, like just rotting in the rain, essentially. All of that capital that went into that, whatever he spent on that mortgage, I don't know if he could ever sell it or even recoup any of that initial investment, or if it's just dead money. But that's kind of the point. And then these new, modular homes that, young millennials, Gen Z, and then up and coming, Gen Alpha. I think that's our kids. So they're still 10 to 15 years away from being in the adult consumer market. But I think them, they're gonna have to economize. They're gonna have to do more with less. They're gonna have to spend their dollars wisely. If you think about these homes, what's the amount of square feet in one of these homes? It's like they're small. You can see it in the pictures, right? It's not going to be the ridiculous McMansion where you just keep loading up, whatever goods you buy on Walmart or Amazon.com, ship to your house 2 day. and these things just keep accumulating in your massive square foot home that you put
Until
no
you
thought
start putting
into.
them in self storage, Matt.
Well, then self storage, and then eventually you just realize like I don't need any of that, and it just winds up in a landfill.
Yeah.
But my point here is all of these economic trends are like ripe for a shift. You can't with that type of square foot. You have to economize, and I'm sorry, you're not going to go on Amazon and just buy ridiculous stuff that you don't need that you have to just put in a closet somewhere because you don't have a closet or a dugout basement to just load up and inventory all your stuff that you'll never use. So, yeah, this has implications for like all of the goods economy, right?
Yep.
U.S. imports, all of the above is kind of captured in this housing
And
trend.
it's housing broadly, not just the housing units, but housing broadly is 15 to 18% of U.S. GDP. So it's I mean, I think everybody understands this. Like what you're saying, Matt. It's a monster flywheel, right? You have household
Yep.
creation, you have a big house, you fill it with
Oh,
stuff that requires you to work and spend and
yeah.
right and
Well, this is also bundled into the QT decision,
yep.
right? What the FOMC policy adjustment or the policy change on the March 19th meeting said they reduced the Treasury runoff on balance sheet. Didn't touch the mortgages, right? Fed wants to get rid of its mortgages, like for real estate and mortgage debt. What they're saying is Fed does not want to subsidize anymore. Private markets, private capital is gonna have to subsidize your home mortgages now. Is the dominant trend. Fed's number one objective for its balance sheet is making sure the Treasury continue to fund itself. They care about the Treasury debt, the Fannie, the Freddie, the mortgage pools, all of that. They're saying like private market. They're saying banks, non-bank lenders, all the above. You guys figure it out. You are going to have to fund this, and if you don't have the Fed, subsidizing the mortgage industry, which if you go back and look at 2020, 2021, the amount of QE that went into buying mortgages was massive. It was like a majority share of the new issuance. Fed was absorbing that on its balance sheet. Fed was totally subsidizing the U.S. Consumer mortgage market last cycle, right? They're saying right now that's not on the table. There is no Fed put behind the mortgage industry, which means higher rates. Now, if you get lower Treasury yields, right, your mortgage rates will proxy to that, so that'll help it out. But this is not the world where everybody who qualifies for essentially a Fannie or agency mortgage, stuff like that, is going to get 3% or 3.5% or lower. You're going to get less house, and it's going to cost you higher rates. Is the reality facing home buyers over the next decade? Is what it looks like.
Can you go back a handful of slides to affordability? I Why don't you put
You
it
just
back up
borked it.
there?
You
Sorry.
just borked us. I'm gonna have to renew this. I've got our videos on, but you can talk
Okay.
to housing affordability
Yeah.
now while I pull this back up.
Here's where I want to go with this, Matt. While you, by the way, I think we're going to do a podcast exclusively on how to set up OBS because we're learning a lot here.
We'll probably get more viewers.
We'll probably get a lot more viewers actually. So if you want to go to slide, one more. Yeah, there you go. So yeah, you're slowdown in this gap is my first point here. So on the sentiment side, I know there was new consumer sentiment out that was not great about inflation, but on specifically to housing affordability, on the right side of that chart is, you know, people who are not concerned about affordability. I'm like, this is nobody, right? These are bad numbers, right? The chart on the right is the gap between you're just looking at the destruction of purchasing power here. Your sales price just keeps skyrocketing, and median income is not keeping pace. So that's one side of it. And then if you go, Matt, maybe advance to 1, 2, 3, 4, like 5 slides to slide 11. So that's the one. So then there's no, according to the CEO or co-CEO of Lennar, they haven't seen any impact yet of basically immigration crackdown that the administration has committed to. Undocumented workers are a massive portion of the labor force that builds, especially site-built homes. So we had talked a little bit earlier about, okay, these manufactured home suppliers are actually doing pretty well right now, and it makes sense because they build small houses more efficiently. But site-built, even if it's not the McMansion that Matt was talking about earlier, site-built homes are still almost 90% of the market. So one thing to watch out for is how aggressive is this administration going to be in this crackdown on undocumented immigration. And my gut feeling is that there's a lot of money and politics involved in home builders, and I'm guessing that their subcontractors are going to start screaming bloody murder if their labor pool is drying up. So I think there's going to be a limit to what is going to go on there on that side. But if this does make an impact, you're just gonna see increasing costs. So if we advance one more slide, and then Matt, I do want to get your thoughts on there's different periods of history where you see these like late cycle slowdowns in housing. So there's tons of data out there. There's people who are way more expert at this. Lance Lambert is a good follow on X, by the way. He runs Resi Club, so give him a follow and look. But to follow him. But the numbers that I'm seeing that are interesting in terms of a slowdown are new home supply is creeping up to 8.9 months. That's the general consensus is 5 to 6 is a balanced market. Price cuts, 16.8% of listings have had price cuts. That could be impacted a little bit by we had obviously the tragedy in LA. There's obviously a good chunk of real estate there now that's being kind of marked down and liquidated. And then also Florida, they had impacts from the hurricanes. That I'm not sure if that number sticks. And then pending sale cancellation rates, that's a little bit elevated, 14.3%. So those are the kinds of things that you look at to see if cracks are forming. As of now, my view, and I think the consensus view, is the market's just sort of trading flat, and probably there's a problem if there's a spike in unemployment. Because the fact of the matter is people still need homes. We're short of homes, and they're going to buy houses, but they're probably going to squeeze the sellers on price, or they're going to squeeze builders on concessions and buy downs, or they're just going to buy a smaller house, which is also an option. And by the way, the trend that you'll see here in a locale like Seattle is you're seeing zoning reform. You're seeing a lot more ADUs and DADUs on single-family sites. So instead of these McMansions where you buy one site and you build a 4,500 square foot home.
ADU stands for additional dwelling unit. DADU is dad's additional dwelling unit, right?
It's detached, yeah. So yeah, so
For your
dad's
divorced dad.
yes, it's dad's man cave. No, so what you're gonna know is builders are, and I'm seeing it in my neighborhood. Builders are buying properties. They're building a main house, and then they build a breezeway and another house, a little house that almost looks like a standalone townhouse. And that's technically an attached dwelling unit because it's attached by a breezeway. It's basically a separate property. Um, and that's your ADU, your additional dwelling unit. And they'll package it up, they'll sell it separately. And then what they'll do is they'll build a DADU in the back. And the DADU is completely detached and it's another third house. So you'll have maybe a 6,000 square foot lot, which is a pretty common size in a city like Seattle. In more suburban neighborhoods, maybe 4,000 square feet the closer you get to the urban core. But you're seeing these big builders come in and build, a 2,500 square foot, very tall main house, and then two little houses right next to it. And that's how the builders are continuing to stay reasonable. I mean, they're going to try to keep profitable on throughput, but they're going to meet the buyers. They're going to meet the buyers where they are. And again, that's just part of that trend of you're going to have smaller house for more money. I think that chart that I had back there says you're getting 7% less house for 79% more money. So,
Yep. So this broad trend, what we're talking about, the housing example, really foots. I'm pretty sure it's von Mises who talks about literally this example of the master builder, the home builder. To pull in the specific book, I'll grab that for you maybe in the post-show notes. But this is kind of a hallmark example in the microeconomics sense to describe the short-term credit cycles, like the boom and bust. And so he calls it the master builder. It's literally a home builder. Talks about the bricks, all the inventory, the resources he goes out. And because of the manipulation and monetary signals, if those are manipulated and give a false sense of the resources available and the cost of capital for projects, what you'll get is, in this case, the master builder, a private home builder who thinks the resources exist to finance his project. And then also a buyer or the market is showing demand for this project, that there's someone who's going to want it on the other side. These things take time to complete. This is the average cost to complete a single family residence in SFR, 12 months, 18 months, 2 years, something like that. It takes time and capital commitment and human labor hours and resources. Like, there's so much involved in the economic coordination that goes into building a house. And when you tinker with the price signals, that interest rates and the mark to market of cost of resources in the short term, what you're actually doing is giving a false signal to entrepreneurs, private actors, and they go out and take on productive activities, new projects, thinking they're profitable endeavors. And it turns out society actually never had the resources to deliver against these plans that individuals, firms, etc., were making. And I think this kind of foots into exactly what we're seeing, not just today's Gen Z and up and coming Gen Alpha type of home buyer who is now being forced to absorb the reckoning and disappointment, if you will, where people laugh at this idea of the American dream and the house they thought they could afford, all of that. Like, you're going to downsize, you're going to economize into a house that, now that the realities have been forced to be reckoned with, this is the actual, housing unit that is actually attainable by you. And then all of that other activity, the home building, the suburbs, the McMansions over the past 30, 40 years, those are also proved to be uneconomic and also examples of capital misallocation. But all of this trend, it's like if maybe we would just studied a little bit more history in undergrad and taken more approach rather than the PhD standard or quantitative standard, where there's a belief that because my models say it is so, or my interest rate model, my DSGE macroeconomic model of the economy says that I can technocratically manage all of these things, we wouldn't have to have been in this situation, potentially, that we're facing now. But my perspective, my mental model, my framework, this is kind of like the case in point example of that exact master builder analogy.
Go back 2 slides, Matt. As you talk to this, just go back, because I think that's just the shrinkflation. Sorry.
This guy.
Keep going. I just want you to have a good slide to talk over.
Yep, this is it. But that's my perspective on what's happening, the mark to market, and to the misfortune of today's young Americans who are having to deal with the reckoning of decisions that were made over the last 3 to 4 decades. This is the reality, but ultimately, tough times breed strong people, and I think, going through this will actually make us stronger. No one wants to hear that right now, but 10 years from now, 15 years from now, the fact that we did do this will have a generation of Americans who are belt tightening, economizing, all of that. I think this actually, hopefully times aren't too tough, and all of the core needs at the bottom of Maslow's hierarchy are able to be met, and maybe even we can do a better job meeting those as we focus on things that are of vital importance rather than frivolous. The let them eat flat screens line you heard from Scott Bessent this week. But I'm hopeful that once we get through this experience 15 years out, 20 years from now, you hope it's a positive for the U.S.
You're seeing it. Yeah, you're seeing there are political shifts that I think are positive related to this. That if you've heard of the YIMBY movement, and I'm just specific to housing right now, YIMBY is yes in my backyard, and there's actually a reasonable. It's a surprisingly bipartisan movement for things like zoning reform. Now, I have no problem with, and I don't think anyone should have a problem if you want to buy a home in a HOA. Those are very prevalent in the Sun Belt. You want to buy a home in an HOA. For sure that there's codes, there's grass codes, trees, all that stuff. Like, you're paying for that. Like, you're buying into that, and you're buying into that enforcement of zoning. So someone's not going to come and build a bunch of dadoos on their property right next to you, which some people don't want that. So you're seeing it probably, maybe it's more coastal, but in Washington State where we are, there's a bigger push for zoning reform. And in my view, zoning reform, really what it is you're actually just getting rid of sort of zoning socialism, where I don't think you really have a right to buy a property and then lobby government for decades to prevent other people from buying property and building on it something that they want to build that the market desires. Now, I grew up playing Sim City, so there's a little bit of common sense. If I buy a property in a neighborhood and I say, I'm okay with pretty loose zoning, you're not going to have somebody come in and build like a glue factory next to your house, right? Like or heavy industrial, as you'd zone it with a little bulldozer in Sim City. That's not the point of the reform. So it's not complete laissez-faire, free-for-all capitalism. But to Matt's point, there's belt tightening, but I also do think you're going to see more movements with bipartisan support, like YIMBYism, where they say, wait a minute, okay, single family residential zone neighborhood near Seattle, like, okay, maybe we're not going to put up a bunch of 15-story apartment buildings, but no, we're going to let people build ADUs and DADUs, and we're going to let people build tall structures. And guess what? That actually assists with family formation, housing formation, affordability. And personally, I to me, that's capitalism, and that's actually what we should be doing is like let the builders build the things that the market is demanding. So I get very rankled when I kind of see the NIMBY mindset from both sides of the aisle. It's like no. If people complain about, oh, the city's not affordable, yet you're the one at the town hall saying like, no, I don't want zoning reform. So like politically, these and tying it back to what we were talking about earlier, in Europe, what's going to happen is they say, okay, well, the U.S. doesn't seem inclined to provide all of our defense anymore. It's like, well, politically, you're going to have to say, well, we're going to have to pay the bill for that and build out our defense. And so these things to me are going to show up politically but you're right, Matt, it's going to be like decades probably. You're going to see these movements. You're probably going to see more YIMBYism, smaller homes, let people build more density to hope this.
So it turns out 1980s weren't the end of history.
Yeah.
That's kind of what the takeaway. All right. One last slide here. Just to end it all, just looking at the metrics. Left-hand side in orange is median days to secondary market real estate sale going pending. That one is moving up and to the right. And then for sale inventory listings in blue also continues generally to move up and to the right. And then monthly housing delisting. So MLS listings that go live with a realtor. Ultimately, they get pulled from the market for whatever reason.
So
each one that's on the right in gold. Each one of those could be its own anecdote, but on the whole, they're telling you something in that data series. When the delistings pulled, what it's saying is, hey, something's happening here with price, where the seller didn't like what they saw is ultimately what happened, and they don't intend to go forward towards closing a transaction.
Well, and there's optics to that, to round that out. Remember we talked about builder incentives earlier. Well, that's an optical thing. They want to sell the house for the listed price because they call it price integrity. They want to make sure they have price integrity. So the builder, if we're talking about a new home builder, the builder's going to offer an incentive to keep that price level, even though they're going to eat some of the costs to buy down that mortgage, but they maintain price integrity. And these delistings are doing the exact same thing. So I personally know people who build, and the tactic is you throw the house up on the MLS at a price, and you get feedback pretty immediately. Other agents come in, they start looking at it, and pretty immediate feedback on, okay, we need to see this or that, maybe an improvement or add something to it. But more often than not, it's what Matt said, is that they're going to get feedback to say, like, I don't have buyers for you, man. Like, they're not going to buy at this price level. So what you do is, instead of you can pull it down very quickly, and optically it's, oh, okay, the house hasn't been sitting on the market, and that's the chart on the left side of it, the mean days to pending. That artificially suppresses the mean days to pending, because you don't want your house sitting on Redfin or Zillow for 100 days. It looks bad. But Matt and I have a good friend who will tell you really the only variable in all of this is price, and it's true. It's just price. The house will sell. What these are telling you is it's just not selling for the price that the seller wants to get, and that's going to put downward pressure on it. But it's early. We'll see what happens.
It's going to be fun as price discovery takes place. Yeah. When I say fun, it may not actually be for a lot of the longs here.
Yeah.
All right. Well, let's wrap it up. And so next week, big event to look forward to, Liberation Day. It's been marketed heavily for well over a year now in campaign season. So hopefully we'll have some interesting activity to talk about next week. But that's, in my opinion, the number one thing to watch. And then Friday we'll get a jobs report as well. So exciting week next week. Thanks for tuning in, and we'll be back with you next Thursday with Cameron return. By the way, and I never said where Cameron was. Cameron was out for a family wedding
wedding
today. So Dave and I held down the fort. We'll see. Expect to see Cameron back with us next week, and we'll take it from there.